Hello and welcome to Buy or Sell. I'm your host, Adam Keily, host of Comedian versus Economist, and widely regarded as one of the simplest minds in finance. But luckily for us, I'm joined by an expert to educate me and hopefully you on how they're thinking about stocks and the stocks they're thinking about. This isn't a deep dive, though. We've got 10 stocks to rip through as quick as we can. And I'm really excited to welcome Nick Guidera, portfolio manager at Eley Griffiths Group. Welcome, Nick. And let me just start, Nick, by offering a bit of an apology. I feel like I've invited you into the Buy or Sell studio in possibly the most chaotic financial environment in recent memory. But welcome to you, Nick.
Thanks, Adam, and I appreciate the apology. It's certainly uncertain times.
Yes.
But that's par for the course in this game. If it was easy, everyone would be doing it, I suppose.
That's right. Perhaps this is where you earn your money, right? This is
Exactly.
where you can either shine or fall.
You've got to protect people's capital as well as trying to make money for people at the same time.
Yeah, we are recording on the 9th of April. I should mention that. I only mention that because of the volatility at the moment. So things you hear on today's show, buys or sells, could be completely out of the water or out of the window by the time you hear this. Nick, I do want to just start by getting a vibe for you and your investment philosophy. And I like to do that by asking you what your theme song would be if you had to have one. What's your walkout song?
Well, I thought long and hard about this, and I even tried to put my investment style into ChatGPT to work out what suited, and some of the responses was a little bit concerning.
Right.
So I went with
based on recent prompts to ChatGPT. Never expose your browser history. That's my motto.
I think it was more the trying to sort of couple multiple facets of being an early stage investor with, someone in small caps, and maybe ChatGPT is not quite there yet. But look, I thought about it and I settled on Never Tear Us Apart because I feel like
in excess.
I'm a market animal. I like markets. I like the macro. I love the geopolitics. I love meeting founders. And in a way, it's a relationship with the market where you're constantly sort of learning and being educated from it. But you also don't want to spend too much time away from it because you never quite know what's around the corner. And these times is a perfect example of what makes markets great, because you're continually challenged whether the stocks that you thought were safe one day are not safe the next, which are things that are out of your control. But that's what makes it interesting.
Let's crack on with your stocks. We've got, I think, 10 to get through. And we're going to start by looking at Temple & Webster Group, ASX TPW, currently trading at $14.92. And I read people are buying essentials. So the chief executive, Mark Coulter, said no more art and mirrors. Instead, people are buying couches and taps. I mean, who needs mirrors? I don't want to look at myself in this climate. I just want to just give me running water. Is that where we're at now? Well, is that all we need?
There's a well-documented cost of living crisis out there. I think the politicians are talking about it most days during this current election campaign. And people are looking for value, and they're using online to compare between one couch and the next. And Temple & Webster as the largest online homewares and furniture player in the country is well placed, because not only have they got the inventory of the products that people are looking to buy, they've got the technology to help people buy them and ensure that they show up in that comparison as relatively compelling. What's happening out there at the moment is people are shifting their consumer purchases online. It's a structural thing. We've seen it happen in the US and the UK, and in some ways Australia is lagging behind the rest of the world. We're catching up, and fortunate for Temple & Webster, their competition is really lagging behind because they've got large shop footprints and leases. They can't really go and invest millions and millions of dollars into a website to kind of compete. So Temple & Webster has kind of made buying a couch online a reality versus 10, 15 years ago, it wasn't, and you had to go and sit in them all. And I think how they've done that is through really good growth in customers and having a good proposition that resonates from a set value. And how they do that, they've got, I think, roughly just over 40% of their products now are exclusive. So you don't search for a branded brown chair, you search for a brown chair. So realistically, they can have exclusive products over a particular brown chair that people are excited about or on trend.
Right. Yeah.
Which actually puts them in a pretty unique position because it's hard to cross-shop the category. It really comes down to personal taste.
Is that a bit like Kmart did something similar, didn't they? When Kmart just, like, it went viral, all the sort of, there was groups springing up all over the place, like Kmart addicts and all this sort of stuff, that people were just just love this random stuff from getting through Kmart. But
Kmart did a great job. They did a great job of re-engineering the private label. Anko is the Kmart brand. Temple Webster isn't all, low quality. They would sort of position themselves as sort of an aspirational mid-market brand where your couch will last as long as you want it to last for, sort of thing. But at a price point that's appealing to the consumer. And why we like it is, you've got long-term structural growth in that migration to online. Yep. They're at revenue just about $500 million at sort of FY24. They're on track to do $1 billion on the next, in their current strategic plan. So you've got that nice runway. At the same time, they've got really good unit economics because of that high proportion of private label goods. They don't pay as much to XYZ brand to sell their product online. At the same time, because it's online, they don't have leases. They don't have the same level of staffing required to do it. So they've got operating leverage will actually come through that business as they scale. And they don't have a heap of competition. So, and why it's interesting now is when in all this uncertainty that's going on in the world, there aren't tariffs between Australia and China or Vietnam where they're sourcing a lot of their products from. The Australian consumer has been through a cost of living crisis and is now likely to see more rate cuts, partly due to what we're seeing overseas, but also now. And you're going to see housing turnover pick up because we've been in a pretty poor housing backdrop for the last few years. That should improve with lower rates. People need to buy new furniture when they move house. Pretty simple.
Yeah. All right. Excellent. Temple & Webster is a buy. Next, we're going to look at Mesoblast Limited, ASX MSB, currently trading at $1.60. Mesoblast set for blast off, Nick, or not?
Oh, look, I mean, the sales are difficult in this market environment, to be perfectly honest with you. And it was difficult coming up with this list.
Well, they're easy. Everything's going down. It's fine.
Well,
just sell everything.
Correct. So, but some may push back and say, well, it's already gone down, so how can it be a sell today? But I think what you're seeing is there's still stocks out there that are relatively expensive that either don't have the earnings, so they're not actually making a whole lot of earnings or cash. They've either got a balance sheet issue, so they're going to need to have funding in the next little while. So what I've tried to focus on with my sales is just those companies that there may not be anything structurally wrong with these businesses. It's just that with a long duration until they're generating cash and a really uncertain market backdrop, they may need to rely on capital markets to kind of help that funding through. And I think Mesoblast is a very simple biotech that's not making a whole lot of money. Not making any money, to be honest, right now.
That's a problem.
It does have FDA approval to be able to make money in the future. And they're in stem cell technology, which is a particular type of technology that they've been developing for a number of years, and they've spent a fair amount of time doing that. But this is a company that still has a market cap, I think at most recent time, of over $2 billion. So you've got a $2 billion company with very little revenue and earnings generation, with some debt on the balance sheet. I think it just becomes a lot harder. No matter whether you're selling ice to Eskimos, you will need dollars to fund your growth over the next little while. And if capital markets are closed, it's one that I'd probably avoid.
All right. Mesoblast is a sell. Next, we've got Australian Finance Group Limited, ASX AFG, currently at $1.57. I was looking at their website and I saw a team putting sticky notes on a glass wall, and I just thought that screams innovation and agility. I'm in. Nick, AFG, buy or sell?
I wouldn't call it the most innovative and agile company.
Sticky notes on walls, Nick. That's all it takes these days.
But ultimately, what AFG is it's a mortgage aggregator. So I think 80% of the country now are dealing with mortgage brokers for their to get their mortgage rather than going to a bank. And these guys provide services to mortgage brokers to enable these mortgage brokers to function. They do that by providing to technology solutions, insurance, all sorts of different things. And how they make money is by charging for those services.
Yeah.
were taking a percentage of the amount of commission which these brokers are given by the banks themselves.
Yeah.
They've also got an origination business, which is a big word for a home loan business, that basically they will compete with the banks, and they'll typically sell to, the physiotherapist that might work for himself, or the plumber that has the plumbing business that still makes plenty of money to be able to support a mortgage,
Yeah.
but perhaps doesn't have the paper trail that the banks would like. So call it
Yeah.
loans
Yeah.
slightly outside the box.
Yeah.
Why we like this one is these businesses have struggled in the last few years in the advent of fixed rate loans, which they've really struggled to compete with, as well as a depressed housing market, which has meant that housing turnover has been low. So less people applying for mortgages and settling on their homes.
Yeah.
So their two kind of drivers have been under pressure. And what you've seen more recently is obviously the advent of rate cuts and the like is a better outlook for a housing turnover over the next sort of 12 to 18 months. Lower rate environment means that their home loans are more competitive versus the banks out there. And you're not paying much for this business because it's seen as a cyclical financial.
Yeah.
So in a lower rate cut environment, non-bank financials typically do well. Now, yes, if we see a major recession in Australia, which I'm not forecasting there will be one, or a major global slowdown, and we see dislocations in credit markets, then this stock may struggle in the months to come.
Yeah.
But based on what I know today, that credit markets remain relatively stable, and the Aussie economy is relatively immune from the US tariff chat, then I think this is a good way to play a recovering housing market.
All right, excellent. AFG is a buy. Next, we are looking at Iperionx.
Iperionx, yes.
ASX IPX, currently $2.21. Titanium producer. I'm a big fan of titanium. I keep some with me in my leg at all times.
Lucky you.
Thanks to a soccer injury I sustained when I was about 20. I've become quite attached to it. Iperionx, a buy or sell?
It's a sell for me because it falls into that same camp of expensive stock that requires capital in the near term with limited revenue or earnings visibility, because they're in this stage of determining whether their pilot project will ultimately become a production facility, and that is producing advanced materials in the US. Now, while they may benefit, and I've seen some headlines to suggest that they may be a beneficiary of this tariff environment because they're ultimately bringing titanium production into the US and reducing their reliance on exports, they're still going to need capital in this environment to either prove out that their pilot project is sustainable. And I think that capital at most recent numbers was in the vicinity of US $237 million to kind of get their project up and running. And that's not likely to be spent until 2026. So you end up with this environment where these stocks that have largely been bought by investors on the hope and the prayer of what may be as this titanium revolution takes place, and it may well be the case. It's just that ultimately they're going to need capital to fund it, and there's not a whole lot of valuation support for this stock, given there's no earnings in an environment where capital might be hard to come by.
You've mentioned the tariff environment a few times. How much has that changed your approach in terms of picking, buys and sells? And like, are we sort of factoring that environment to stick around for a long time? Like Trump's not going to reverse those tariffs, and that the environment is going to change substantially. Like, how much do you factor that in when you're looking at these stocks?
A lot is the short answer.
Yeah.
And I think I'm probably more in the camp that the challenge is not the tariffs themselves. The challenge is the confidence that has been eroded from businesses and consumers globally. And it's very hard to regain confidence without certainty. And I think that because the tariffs is such a complex being with a whole bunch of moving parts, and that's where tweets are dictating directions of tariffs and markets, it's incredibly difficult to sort of see confidence improve within businesses, which will ultimately invest again. I'll give an example. I spoke to a company yesterday. I won't tell you what the company was, but they have 3 different manufacturing areas across Asia with different tariff regimes on each of them then sell into other OEMs that are based all over the world, which then sell into the US. So what's their tariff impact? I mean, they're trying to work it out, but I think at the end of the day, they don't really know. And therefore, if you're looking at whether you ramp up production in anticipation of future demand and you can't really determine what the demand profile looks like, do you perhaps pull back on the on that investment? And the same goes on the consumer side. If you're looking to go and invest in a new office upgrade, something really simple, can I forego that for a bit just in case our business suffers in this environment? I may not need as many staff as I want. So the reason why I think I've had to think long and hard about these sells is I do think this environment will continue for some time. You may see resolution on certain tariffs, and you may see the market move up, by the time this podcast comes out in a week's time. But I think, unfortunately, there's a bit of a crisis of confidence, if I can use that term.
Yeah.
And at this point in time, it is very difficult to see how that changes without wholesale change in the approach that either the Fed is taking or the US political environment. And I think, unfortunately, Australia is just a victim of the global phenomenon.
All right, cool. Iperionx is a sell. Next, we're looking at Genesis Minerals Limited, ASX GMD, currently trading at $3.64. Genesis Minerals up 73% over the past year. They seem to have an invisible touch. Just a little, a 40-year-old Phil Collins reference. Sorry.
I like it. Is that your investing song?
At the moment, it's anything by Simply Red.
Yes, it's been strong because gold's been strong. And I think on a relative basis, gold is a relatively safe place to hide. Yeah. Now, is gold expensive, cheap? That's for macro investors that invest in the physical gold to make that assumption. But I can see a case for why people want to hold gold in their portfolio, given the uncertainty that's crippling equity markets, fixed income markets, FX markets. They need to invest in something as a store of value, and often, and gold has been that for decades and decades and decades. And I think right now the Aussie dollar gold price is hovering around that $5,000 an ounce. So any pure play Australian gold miner is making a lot of money digging up dirt from the ground, processing it and producing gold. And there's probably a number of gold companies that are making more than others because of either the quality of the gold or the production profiles, etc. And in some ways, this gold price is perhaps seeing some sub-economic projects become economic again. Yeah. But how we kind of look at gold is we want to back really good management teams with good projects, with decent kind of production growth. We kind of look at it like an industrial. If you can create a scenario where a gold company can be consistent, granted that there's a commodity backdrop that may be volatile over time, but all the other drivers are ultimately working with them, either increasing production, improving grade, whatever or efficiencies on the cost line. That's the kind of gold companies we like to back. Genesis is a really interesting one in that it's founded by, or not founded, it's run by Raleigh Finlayson, who was the former CEO of Saracen Minerals. Saracen Minerals was a large gold company that he sort of took from a small company to a large company and saw it merge with Northern Star at a $6 billion valuation. Genesis is his second time round. And he came into this business sort of, I think it was February 2022 as an MD. He's done 2 deals along the way, buying a gold mining company that had gone broke, and then buying another asset off a producing gold company that was having some production issues. And he's merged these assets together, come out to the market with a 5-year strategic plan about how he's going to run them better and run them more efficiently. And the market's engaged with it because ultimately he has one of the strongest production profiles in WA, doesn't have the geopolitical risk of other countries. He's got a pretty good cost environment. He's got optionality around different growth options. And for people that want that safety in their portfolio around owning some gold, you may as well own the best one.
Couldn't have said it better. Love it. All right, let's take a break here, grab a word from this week's sponsors. Hey, if you've got a stock that you want to hear about on the show, let me know. You can use the contact form at equitymates.com or flick us an email, contact@equitymates.com. We'll be back right after this short break with some more buy or sell.
When it comes to good investing, good research is paramount. And we know that sometimes you don't always have the time to dig through financial statements and find those individual companies.
And even if you love researching stocks, it's always good to get a second opinion, to get differing voices, and to uncover companies you may not have been looking at, which is why we love good research.
Good research is how I found Antipa Minerals, one of the companies that is in my $500 to $5,000 challenge. It's also the research that Luke and Ben use from Seneca Financial Solutions to generate 36.5% per annum returns on their top-rated small caps fund.
So what do you get? You get 2 in-depth reports each month on ASX-listed companies with a real focus on emerging companies and investing opportunities that a lot of investors are overlooking.
Good research is only limited to 200 subscribers, so don't miss out. But the good news is, as an Equity Mates listener, you get 10% off at checkout using the code MATES.
So head to goodresearch.com.au to sign up, but be quick, spots are filling up fast.
Good investing starts with good research. Don't miss out.
Welcome back. You're listening to Buy or Sell. My expert today is Nick Guidera, Portfolio Manager at Eley Griffiths Group. Nick, we've got a few more to get through here, and we're going to kick it off with Australia's very own meme stock, DroneShield, ASX DRO, currently trading at 86 cents. Maybe it should be Drone Stop instead of DroneShield, just to make it even a bit more memey. But this was the talk of the town for a long time. Where are we at with DroneShield? Buy or sell?
It was, you're right. It's been one of those popular stocks amongst retail investors. And I think for us, it is just that. It is a little bit conceptual. There's revenue and there's earnings, but there's not a whole lot of visibility. And ultimately, there are 10 plus companies in the world, some behemoths out there that are trying to go after these drone detection and drone disablement technology that DroneShield has produced. And I think it will be an interesting environment as drones become more ingrained as part of modern warfare. And I can see why investors have kind of gravitated towards looking for some exposure towards the defense stocks, because a lot of the defense stocks globally have been particularly strong, and Australia doesn't have many of them. Why it's a sell for me is I think you've got a new administration in the US, which means that a lot of the US contracts that they have been talking to may just get pushed to the right a little bit. Right. And you're also going to see, I think, perhaps more challenges around, as I said, revenue visibility. You've seen analysts revise down forecasts, I think, on the last 3 quarters, because expectations, both from the analysts that cover the stock and perhaps some of the investors in it, were higher than the reality of the conversion of those contracts. Okay. This isn't a business that's going to go broke because it's got $100 million of cash on the balance sheet. They were smart raising money at the time last year. So it's not an issue whether it's a going concern or not. I think it's just perhaps the wrong valuation, $750 million market cap, in an environment where earnings certainties probably comes into question. Yep. And you perhaps could be owning better, more defensive stocks in this environment. Not from a defense perspective, but just
I was going to clarify. Do you mean defensive as in defense or
and things that are a bit more stable? Consumer staples, utilities, those kinds of environments, than stocks that are relatively high risk that don't have valuation support.
Yeah. All right. DroneShield is a sell. Next, we're looking at Auckland International Airport Limited, ASX AIA, currently at $7.14. Always good tax benefits I've found to buying airports, because large parts of them are duty free. Nick, Auckland International Airport, where are we at? Buy or sell?
So Auckland Airport is a buy for me, and I think it's as simple as you've got a monopoly asset in a country that relies heavily on tourism. Pre-COVID, tourism, I think, was up to 5 to 6% of New Zealand's GDP. So it's a pretty large aspect. And I think you had over 3.9 million international passengers through their airports sort of pre-COVID. You're not quite back up at those levels, largely as a function of Air New Zealand's struggled with some of its capacity because they've had some issues with some of the jet engines. So a number of their jets are actually parked up at the moment. And you haven't seen the incremental capacity coming back into New Zealand from the global carriers, albeit there's a lot of positive conversations around what they may look like. I mean, airports are a pretty good good businesses in that you build the asset, they come and you charge them money as they pass through your doors, whether that be passengers landing, the aircrafts landing themselves, or parking, duty-free, etc. The beauty of this asset is it is a monopoly asset, and that I think it's the majority or 3/4 of all international visitors in New Zealand come through Auckland Airport.
So that's what separates it from a Sydney Airport or LAX or some other airport in the world. You're saying it's that monopoly that they've got.
Correct, exactly right. And I think the other thing that's interesting is New Zealand's been through a pretty tough period of time. You're seeing a whole lot of rate cuts, which should stimulate economic growth. So you should actually see not just that tourism dollar, which has kind of been chased down there on the back of a weak New Zealand dollar, say, versus the US, but you actually should see improving economic growth prospects in New Zealand, which could drive incremental flow through these airports. They're also spending a large amount of capex over the next few years, about $7 billion, but they've got a really good balance sheet to be able to fund that. So while it's expensive for an infrastructure asset, it still looks relatively appealing versus perhaps some other infrastructure assets that have changed hands globally in the last sort of 12 to 18 months, particularly given its unique nature as being sort of the monopoly airport in the country.
Yeah. All right. Auckland International is a buy. Next, we've got Nuix Limited, ASX NXL, currently $2.47. This is fascinating. I was looking at this last night. So let me see if I got this right. So Nuix is an investigation and analytics software which is used by ASIC, and ASIC was investigating the Nuix CEO for insider trading, using Nuix software presumably to do the investigation, while at the same time negotiating a new deal with Nuix to keep using their software. That's a tangled web. And the case was eventually dropped because apparently insufficient evidence.
I can't comment on that particular specifics, but I know that it is used by ASIC and other regulatory organisations because it is a case management tool for law enforcement. But police will use it to manage items of evidence, digital forensics. Lawyers use it when they're putting together their cases, in e-discovery. So often you have to trawl through hundreds and hundreds of papers to work out which data point's going to support your evidence. So it is critical software that has plenty of existing customers. Fundamentally, I think it's a good business. It's what I struggle with at this point in time is they're going through a bit of a transition. So they've built a cloud-enabled product, and they're trying to move their customers into that cloud-enabled future. And what's happened is that requires customers to upgrade, spend more on the product, etc. And a lot of these customers, as you've identified, are law enforcement, they're government organisations, they're law firms and the like. And while they may be open to transitioning to that cloud version of the software, in any kind of uncertain environment that we're in at the moment, decisions just get deferred. And the company actually gave an update on Monday this week indicating that future deal closures were at risk because timings were being blown out. And they've got guidance out in the market for, I think it's 11 to 16% ACV growth for this year, which is basically, in simple terms, that's the amount of contract value that they're looking to grow in this particular year. But they're saying that they're tracking towards the lower end of that because of these decision timelines. And I think, unfortunately for this company, while they've spent a lot of time and money on investing in this new cloud version of their product, they ultimately need people to buy it. And if there's a lack of business confidence, as we've talked about earlier in the show, it's not governments and public sector organisations are not going to be immune from that environment. So any upgrades just may be deferred to the side. And I think while the valuation has come down a lot already, and it's perhaps a lot more compelling than what it was, if you're likely to see further earnings downgrades because they don't close these deals, then the valuation just may not be as compelling as what people think.
Yeah, I guess it's like the cost of living crisis, right? Everyone's confidence is down and tightening their belts, and this is not the right time to be upgrading the family car, perhaps to a new model. So you just push that decision back for it. Yeah.
I think it's the same for business.
Excellent. All right, Nuix is a sell. Next, Generation Development Group Limited, ASX GDG, currently $4.20. 29. The CEO is former Olympic gold medalist Grant Hackett. Nick, are we diving into GDG?
Yes, he is, and he's been in that business, I think, since 2017 when he was a salesperson and sort of progressed through the ranks to be running the business now.
Some people just overachieve in life, don't they?
He's incredibly impressive, and someone that has someone that's really got a good understanding of what his business does.
Yep.
I went to a presentation last year where he spoke with no notes for 2 hours about the intricacies of one part of his business that was not particularly simple, which sort of gave me a lot of confidence in his level of understanding of what he's trying to do within that business. Right. I mean, GDG is a complicated business for the average investor, but I think to simplify it, I'll use this example. Recent data from the IFA found that about 10 million Aussies are looking to seek financial advice in the next 2 to 3 years. Right. At the same time, you've seen the average number of financial advisors halve since 2019, as you've seen more regulatory environment tighten and more restrictions around who can purport to be a financial advisor. So we've got a large increase in demand and a reduction in supply. The current advisors are overwhelmed with the number of people that they could potentially support. So they're looking for technology and other solutions to help manage these clients. There's the advent of this thing called the managed account, which is effectively a new model portfolio where a financial advisor can put a particular investor into a bucket. And you may have walked through the door and you're a male at a certain age group and a certain demographic that fits a particular risk profile. You can fit in bucket number one, versus the next person that walks through the door, might have a slightly different risk profile and they form into bucket number two.
And they manage is that like a portfolio then that they manage Correct. The portfolio and they just assign you to a different portfolio, let's call it a portfolio.
Yeah. So but rather than managing individual stocks, like what I do, they manage asset classes. So they will determine in the risk bucket number one, let's call it balanced. It may have a percentage of fixed income, a percentage of shares, a percentage of equity, some cash, some property, etc. GDG have a whole bunch of consultants which ultimately determine what should be in those buckets. Yeah. And then advisors come to GDG and say, hey, I'd like to put my clients alongside those buckets going forward.
It sounds a bit like what my super fund offers me. Like they've got, balanced, high growth, super high growth. It's correct. Conservative, all the rest of it. So similar thing.
It's a similar thing. It's just done at the investment level. So rather than necessarily for super, it's done for it's done for high net worth individuals or even mass affluent people that have incremental dollars that they're looking to invest.
It's probably why I haven't heard about it.
Rather than having, to be fair,
no one's knocking my door down, Nick, asking me what I'm doing with my spare $40 a week.
No, to be fair though, not many people have heard about it. So it's a nascent industry and it's one that's growing like a weed because financial advisors are looking for efficiencies. And just like your super fund manages, hundreds of thousands or millions of members in 5 buckets, advisors are looking to do that at scale.
Yeah, very good. All right, GDG is a buy. Next, Macquarie Technology Group Limited, ASX MAQ, currently trading at $54.47. The Millionaires Factory, Nick, buy or sell?
It's an incredibly well-run business, this business. Yeah. It's won awards for how well-run this business is. So it's not a sell because of the quality of the business. It's a sell because right at this point in time, the shares are still relatively expensive for a company with very limited earnings growth over the next couple of years. Yeah. And they're in the game of data centers. And if you've turned on the TV in the last and you have an interest in markets in the last 6 to 8 weeks, you would have seen that the data center thematic has been under pressure on the back of the DeepSeek announcement that happened earlier in the year. And there's a real concern that perhaps we're facing this overbuild of data centers. Now, I'm not suggesting that the capacity that Macquarie Technology is looking to bring on is contributing to that overbuild whatsoever, but the sentiment towards the space is particularly challenged at this point in time. Yeah. Now, sentiment is only one part of the reason not to own a stock. I said the more fundamental reason is they're in CapEx phase. So they're actually building an incremental data center at the moment and spending hundreds of millions of dollars per year over the next couple of years as they build that data center out. Unfortunately, though, a lot of these hyperscalers like Microsoft and Amazon and others get to make the decision on whether they take that capacity a lot closer to when the data center opens rather than when they turn the key and start the first shovel. So there's a bit of a risk, albeit very limited, in that someone won't take the capacity, but because there's no announcement over the next 6, 9, 12 months around who's taking that capacity, it becomes an overhang on the stock as to, well, who are you going to sign it? What are the economics going to look like? Will the data center economics in 12 months' time look worse than where we are today because of this potential overbuild? At the same time, they've got a really good government and consulting business and cloud business that they're in there selling cloud solutions to people. And that's come under pressure because governments are spending less on their outsourcing and the like. So you've kind of got a bit of a perfect storm in that there's very limited earnings growth and the stock's still relatively expensive. So I think for me, you don't need to be there at the moment. There will be an opportunity in the next 6, 12, 18 months to own this stock again. But perhaps when we've got more clarity on who that next tenant is, what the unit economics look like, and perhaps an improvement in their existing businesses.
Yeah, very good. All right, Macquarie Technology Group is a sell, not to be confused with Macquarie Bank, who is, of course, is the millionaire's factory that I alluded to at the start of the break. So before everyone jumps into the comments to let me know that, thank you. Noted. All right. Finally, last one, the big call on the show this week. This is interesting. We're looking at New Zealand as a whole. Are you buying or selling New Zealand?
I'm buying New Zealand.
And how are you buying or selling New Zealand? Do they know that you're buying or selling?
I appreciate that New Zealand isn't a stock, but I think the whole market looks really interesting. And I'll tell you why. Having just got back from New Zealand 2 weeks ago and having done multiple trips over the years, it's getting better. And I was there in September. It couldn't have felt worse. It was terrible. Everyone was down. There was, genuine layoffs. The consumer was really tight, etc. But what you're starting to see is some incremental green shoots coming out of New Zealand because you've seen over 200 basis points of rate cuts.
Yeah.
Because a lot of consumers are actually rolling off their existing fixed rate loans onto new fixed rate loans at a far lower level. So they've actually got some dollars to spend. You've got a new government there that is trying to go for growth. I think that's their slogan. Whether they achieve that or not, I'll leave that for others to determine. But the backdrop is certainly better than it has been. And I think there is a lot of great quality businesses in New Zealand that typically get overlooked by global investors chasing the sizzle of US tech and others. But it's a terrific market that's got good economic growth fundamentally when it's not in a recession, with a far better monetary environment. And if you look at the quality of the businesses there, Auckland Airport is one of them I mentioned earlier, you often get them at a far cheaper valuation than some of the Australian peers or offshore peers because just by virtue of the fact that it's not as well known or not as well understood. There's really good quality retailers like Briscoe's Group that, is probably one of the best retailers out there in the Asia Pacific, has been through a very tough time because consumers have stopped spending. There's multiple examples, whether they be from the consumer to industrials, etc., that I think are poised for a really improved earnings outlook over the next 2 to 3 years. So I'd encourage people to kick the tires and look at how New Zealand may fit in their portfolio.
And how do you play that? Is it? I mean, I know there's a New Zealand top 50 ETF, for example. Like, is that something you'd look at, or you're kind of just going big in a particular sector, or?
Well, the beauty of New Zealand is majority of them trade on the Australian market, the ASX as well. So the majority of the companies are dual listed.
Yep.
So for Aussie investors that are nervous about investing offshore, they can have their New Zealand exposure by looking at the dual listed names to begin with.
Yeah.
The NZX is no different in many ways to the ASX in terms of the regulatory environment and the like. So I think looking at quality names like Mainfreight, for example, which is a global transport and logistics business that happens to be listed on the NZX only, will be you can still take comfort that the quality of the business is just as good as an equivalent business in Australia.
Yep.
So yeah, I think it's kick the tires. I think it should be in the comparison set. That's how I think about it. If you think that the Aussie consumer is perhaps going to be a bit more challenged relative to the New Zealand consumer over the next 6 to 12 months, perhaps the New Zealand consumer is a better way to play that. And then you're layering in your Aussie consumer exposure, 6 to 12 months down the track.
All right, excellent. That's a great note to finish on. That's it. Nick Guidera, thank you so much for joining me in Buy or Sell. Where can people find you if they'd like to hear more from you or keep up with what you're doing?
So Eley Griffiths Group, .com.au is our website. We're a small emerging companies manager, staff owned, been around for 20 odd years. We publish information on that about our funds, and we're regularly in, I suppose, the media and other channels with our views. But yeah, if people want to find out more, there's plenty of information on that website.
Excellent. All right. And you can continue this journey on the Equity Mates website as well. There's plenty of resources there. You'll find the buy or sell tracker for this show, along with the Find a Company page where you can get more info on each of the companies that we've spoken about today. And if you're interested in following or hearing more from me, you'll find me chatting to my Economist brother on Comedian versus Economist podcast with new episodes out every Wednesday. But that's it for us. Until next time on Buy or Sell, it's bye for now.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.